What's the driver for real assets then?
Morning. Yes. Well, nothing's really changed from last year. It's about central bank balance sheets, asset purchases, zero interest rates, negative interest rates. In terms of short-term concerns, we are getting out of the Q4 earnings season in the U.S. relatively unscathed. Around 80% of reported companies so far have beat expectations, what the expectations were, given we've come out of the worst contraction of all time, basically on a quarter-on-quarter basis. And now the strongest rebound. It was a little bit difficult to predict, but that was sort of the short-term issue. But yet, as I mentioned, nothing has really changed in terms of the market moving in lockstep with central bank liquidity and also zero negative interest rates. I think the question now is how far does this reflation trade go? And does the rotation that we really started to see pick up in October of last year, does that continue into some of the COVID laggards that we've seen so far this year?
So how far will this reflation trade go? And what would it take to derail this rally? I mean, you say that if the rollout is completed, that is a sign that perhaps that could be a big correction.
Well, that's certainly not the base case. But, again, if you look at what's been driving markets higher, it has been around central bank liquidity and zero interest rates, as I mentioned. And so, if we start to return to economic normalcy, which is the expectation for the second half of this year, GDP projections are very strong. Earnings projections are very strong. What moves the market higher at that particular point? And so if the market starts to expect that the Fed or other central banks will start to taper, that could be cause for concern for the market. I think that's not the base case, but that's certainly a possibility.
Are markets underpricing higher commodity prices? I mean, we have oil now persistently above 60.
Well, we've seen a big rotation into energy. This makes sense given, again, the market is expecting return to economic normalcy in the second half of 2021. We've seen U.S. dollar sort of rebound here, which is, I think, caught a lot of people by surprise. But we've been talking about this for a couple of months now, the overstretched positioning on the DXY. And energy has done very well. How much further above $60 on Brent we can get? I think most target prices across the street were around this level. So I don't think the expectation is that we can move that much higher. But again, this is a reflation trade, money moving into broad emerging markets. We've seen a lot of selling off in fixed income, and I think that some of that is being driven or being used to fund a rotation into equities. Where 2021 was all about fixed income, into October, November, December, we've seen that rotation, fixed income into equities, U.S. into emerging markets. We've seen a lot of interest in China bonds, all the southbound flow that's coming into the Hong Kong market as well. So add into that energy, financial cyclicals, and small caps, which has been sort of our preference to play the reflation trade. And it seems like there's a lot of momentum there.
Thomas, I think that there have been a few commentators out there that this rise in U.S. nominal yields hasn't created something similar to the taper tantrum. What's your view of it?
Well, that was one of our key themes for this year, was that even if nominal yields pick up, we're really looking at real rates, and real rates are still low. So I think real rates are really what are going to drive asset prices. So the expectation that nominal yields can go up, but the Fed will keep real rates relatively low is still pretty risk on. And I think that's become a little bit more consensus. Again, we've been talking about the need to protect against inflation in the second half of last year into this year. I think that's getting more steam now. And I think inflation is a concern, but I think at the moment the market still feels that this is under control by central banks.
Yeah, that's the hope anyway. That's the thing, though. Ultimately, we look at vaccine programs and we look at a world now that we've been living in for the last 12, 13 months where good news is bad and bad news is good for stock investors. So if we do get a good rollout of the vaccine, that's maybe actually negative for markets, given that people will think that central bank support's going to go away as a consequence.
Well, that was my contradictory view that I was asked for, and bad news being good news is not a 12, 13 month thing. It's a 10-year thing, right? So, again, that is a concern in terms of a tail risk, is that if central banks do taper, which they're going to have to do that at some point, maybe not this year, maybe not even next year, but at some point, and when the market does start to expect higher interest rates into the future. That could be reason for a pullback. And we kind of made the point of, if you're predicating your investment view on interest rates being zero for the next 5 years, that could be a mistake. So I think for us, we are pro-risk. I think you kind of have to be in equities at the moment, but we're just saying you need to have a balanced approach to your portfolio and have some kind of inflation hedge and some kind of risk-off hedge in your portfolio, as well as the risk on, I mentioned small caps earlier, and also in places like emerging markets.